if I get stock options from my Singapore employer, what's the difference between how Singapore and the US taxes them? So, we're talking about whether it's a qualified from a US tax perspective, if it's qualified options or non-qualified options. Let's assume it's non-qualified options, which it tends to be because it's Singapore. Then you're paying tax. So when you exercise that option, if there's a delta between the exercise price and the market price, then you would have received the benefit, right? So whatever the market value is, less what you paid for it, that you record that as income. And then when you sell it on, then you have capital gains. So if you sell the shares, normally there's a lockup period anyway. But let's say you're able to sell it within 1 year, then you'll be subject to short-term capital gains. And if you sell it beyond 1 year, so your holding period is more than 1 year, then you're subject to long-term capital gains from a US perspective. Obviously, in Singapore, there are no capital gains. I think where people really get caught up would be there's some deemed exercise rules, right? So if it is that you have options, so for example, if you got options and they did not vest as yet, normally the taxes aren't triggered both in Singapore and the US until something vests, right? So it actually comes to you. When it's not yet, there's nothing, if it's just an option or there's nothing tangible that you own, then there's nothing to tax. So we tend to look, both Singapore and US, we look at the vesting schedule. And when you get shares and let's say they're just an award for service rendered, then, that's pure income to you as at the date of vesting. Now, one of the key differences between Singapore and the US, and this is where people come to us complaining, would be the deemed exercise rules that Singapore has. So if it is your contract comes to an end, or maybe you switch employers or whatever the case, typically when your stint in Singapore comes to an end and you are moving on to another jurisdiction or returning to the US, and those shares did not vest, if those shares were earned while you're working in Singapore, the options were earned or awarded to you while you're in Singapore, even though they didn't vest and they're only taxable when they vested, Singapore has these deemed exercise rules and they will tax you on them even though they have not vested. Now that can become a problem for people for whom they will never exercise the option because they've left the company or they don't meet the terms of the award, of the vesting. So then we work with Bunyip and his team, and it is possible to reach out to IRS, the Inland Revenue Authority of Singapore, and have a conversation with them and let them know, hey, you've left the company. We see this with some of the bigger tech firms, US tech firms that have an operation in Singapore. They're leaving, but they are not entitled to the shares. So there will be no vesting. And once IRS sees the documentation and is assured that there will be no vesting, then the deemed exercise rule would not typically be invoked.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.